All right, everything looking good. We are live. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is 8:04 p.m. Eastern Standard Time on September 28th, 2022. And as always, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right. If somebody could just let me know in the chat, everything's coming through loud and clear. Obviously, I am feeling loud and clear, much better than the other day when I was stuffed up to where I could barely breathe. So we got plenty to talk about today since our last stream was relatively short. And obviously, we had some big plays, not just in the market themselves, but, well, we'll talk about all that. So appreciate you guys. Make sure to say hi in the chat there too. Helps out for the engagement. What's up, Arturo? Good to see you. Says sound better. Yeah, much better, dude. Sound much better. I wasn't really like sick, but it was a pain being all stuffed up. K. Oles, good to see you. Favorite financial advisor? You mean not your favorite financial advisor, or your favorite not financial advisor? All right. So that being said, let's go ahead and jump right in. So, and congratulations to all the group members that were able to capitalize on that quick $1,000 candle. We obviously took big advantage of that and sold into the sweet pump on the 4 hours. So we'll talk about crypto. Had a nice little pump leading up to it. And then we saw a nice little pump kind of overnight tonight. And, spoiler alert, we know exactly what that was. But most importantly, we want to tie all this stuff together because the main narrative now has shifted. Well, in a sense, before the narrative is that the Fed was going to pivot because of us, because the U.S., because it was going to hurt domestically. Now the new narrative is that the Fed is going to pivot because it's hurting everybody else because the dollar's too strong. But again, we have to take that full circle back to way back when we were talking about the Fed, and everybody's been talking about how they don't want strong dollar, how they don't want high rates, how they don't want to hurt other countries. But I think part of what people forget is that the dollar itself is a tool, and the Federal Reserve is using this tool for power for the United States, in my opinion. So that being said, the two big events that happened recently were Fed intervention. But the thing is, they weren't the Federal Reserve of the United States. They were the central banks of other countries. So we saw first the Bank of Japan stepped in, and then second, overnight, we saw the Bank of England step in. And the situation is they both had to step in and buy to keep their currency propped up. Because, it's super simple when we really think about it, but it's very complex when you have all these like players, all these gears moving at the same time. But when you just focus in and you just look at one gear at a time, it's super simple. Essentially, the strength of the currency relative to other currencies is based on supply and demand. So if you create a bunch of supply, currency is going to go down in value because there's going to be less relative demand. The same way that if there's less supply, it would strengthen. So the way we have to look at everything right now is, let's look at our US 10-year chart, and then we'll transition into everything from here. So here's our TNX chart, 10-year Treasury yields for the United States. Federal Reserve, United States Treasury, rather. I don't know why I say Federal Reserve. United States Treasury, rather, but I guess because they own most of them. So, we see obviously the United States bond market, or the yields on these bonds, have been going up like crazy. Well, this is just relative to the actual dollar when we look at this chart. And then we look at the demand relative to other currencies. So obviously a lot of other countries or currencies have been keeping their rates at or around zero. Japan, obviously, for a long time. And then who else? Well, obviously UK as well. So now all of a sudden they have raised their rates up. So they're starting to tighten, but they're not tightening as fast as the United States. Their rates are not as high as the United States. Therefore, people are more likely to invest in the United States. So that's less demand for their currencies, less funding for their governments, etc., when they run deficits. Therefore, the Federal Reserve, or their equivalents of the Federal Reserve, aka their own, central banks have to step in. So when their central banks step in and start doing the same thing, they start, quantitative easing, that obviously weakens their currency compared to the United States. So what happened was basically something broke in Japan in the bond market, and Japan, had to step in. Well, the Bank of Japan had to step in and basically bail them out. And then we saw the same thing with England or UK. They literally just raised their rates, barely, like a pathetic amount, barely raised their rates into positive territory, like zero. And then immediately after just going up to zero, they had breaks already showing up in their financial institutions. So they had to step in and immediately do quantitative easing while they're doing quantitative tightening. So that's like saying, oh man, I've got, oh man, I can't even think of it. Oh, like I want to charge my battery on my car, so it doesn't go dead overnight. And you're like, so I'm going to just hook up this trickle charger to it. So it just gets a little bit of a trickle all night long. And then also you like leave your headlights on full blast, like brights on, everything. Like you're going to wake up the next day and sure, you charged your battery, but did you even charge it faster than you ran it down? Or is your battery still going to be dead? Because that's basically what the UK is doing. They're saying, oh, we're going to tighten up rates. We're going to make money tighter. We're going to make it harder or more expensive to borrow money. And then also they're like, oh, and something broke now. So now we have to step in and buy bonds. We know obviously right now the Federal Reserve is selling bonds. They're selling mortgage-backed securities. They're selling treasury bonds into the market. And that's helping to rise the rates up as they're raising rates themselves. Now you have basically the UK fighting itself. It's now saying, oh, we're raising rates. And then also it's saying, oh, but also we're buying bonds. So if you say we're going to raise rates, we're going to, raise the target rate, etc., on the bonds, and then at the same time you buy bonds. Well, when you buy bonds, we know obviously there's an inverse relationship between the bonds themselves and the rate. So as you buy bonds, the rate goes down. Meanwhile, you're saying, hey, we're raising the rate up. So you're basically just fighting yourself. So, it's moronic. So you can't go into quantitative easing while you're still doing quantitative tightening. You can. You can if you're a retard. So, basically, that's essentially what happened was the UK is actually just straight up fucked now. They're garbage. No offense to my UK people out there, but the government, the people in charge, you basically got rid of one horrible politician and you got replaced by another horrible politician. And maybe I'll be wrong. Maybe this will all work, but it's never worked before. So it's probably not going to work this time. So the move we saw, so that was the whole premise of everything that's happened recently. Two central banks intervening. So now the narrative is, oh, if they're intervening now, it's just a matter of time before the Fed breaks and then they have to intervene as well. Therefore, we're probably bottoming. Maybe we get one or two more rate hikes, but who cares? Because everything's breaking around the world, so the Fed's going to pivot. Well, here's the thing that people don't realize. The Federal Reserve has no ties to the rest of the world in its responsibility to help them out ahead of the American people. Now, that doesn't mean it's not going to happen. It doesn't mean the Fed's not going to pivot. Sure, one day they'll pivot eventually. But I don't think that this tells us we're any closer to a Fed pivot. Because I'm going to tell you right now, if the Fed pivots right now, inflation's going to run out of control. So right now, the Fed is going to sit there and say, okay, so inflation's going to run out of control in the UK for sure because they're doing moronic stuff. So it's definitely, inflation's going to go crazy over there. They have energy crisis, inflation. They're screwed. They're straight up screwed. But should we also just screw over the American people too? So that it's not as bad for them or that just everybody's getting screwed at the same time? I don't think so. It's like if your friend just is on fire, covered in gasoline and you're like, well, there's no way I can save you, but I can hug you and we can just both die together. I just don't see it happening. So for me, this is a non-event. It was just a reaction rally off of a double bottom back test of support, etc. But obviously, this leads to weakening in the dollar and the treasury yield because that creates this, essentially risk on environment. So obviously, if we look at our two key drivers, we see TNX having a pullback. We see DXY having a pullback. Nothing crazy here. They're both ridiculously high levels. They've been going absolutely parabolic. Until we start like violating key levels or anything like that, this changes absolutely nothing for me. I do not think the Fed is any closer to a pivot. I do not think we're even anywhere close to stopping quantitative tightening, let alone beginning quantitative easing, just because the UK government is a bunch of moronic, brain-dead retards. Doesn't change anything for me. It doesn't change anything for me. It changes things if you live in the UK because you're just fucked. But, for the rest of the world, I mean, we feel bad for you, but it could be worse. It could be Ukraine. I mean, I just don't even know what to say at this point in time. The fact that people are acting like this is some like, oh, now the Fed is going to pivot, for me is just absolutely laughable. I mean, if anything, the truth is you look at Japan and you say, wow, Japan like really sucks now. They had a lot of potential, 20 years ago, and now they're shit. No offense again to anybody that's Japanese or anything, not the people. I'm talking about the economic situation. You basically have your own government has to buy all of your bonds. Not unlike the United States, but that being said, it's not all of them. So the UK basically is headed towards Japan 2.0, in my opinion. So did Japan failing hurt the rest of the world? Yes. Did eventually the rest of the world just go on and Japan was just fucked all by itself? Yep, exactly. Now, is UK going to end up in that situation? Probably very similar situation. The only difference is I don't think it'll be by itself. I think there'll be a bunch of other countries, with it. So that being said, that's my rundown. That's my take on it. Obviously we saw some, energy-based rallies as well with the quote-unquote attacks on the pipeline, etc. We'll have to wait until we get more detail on that. I suspect it was probably something to do with malicious intent. It doesn't sound like it was just something that happened. We have no idea who did it or why. It's not going to affect anything really short term. I mean, Nord Stream 1 is basically, off. Nord Stream 2 is never even operational. I just don't, for me, it's just a non-event. I mean, it's like some news to rally off of, but I think the charts were already pointing it out. So the most important thing now that we got that out of the way, that's the news, that's excitement, that's rally stuff. Why did the rally really happen on the macro? What is really happening right now? Well, the monthly is about to end. The third quarter is about to end. So we've been expecting essentially a rally, over the last, we've been talking about 10 days now, 5 to 10 days, where we expected potential pushback up to try to save the trend. So we'll look at the risk on assets and look and see how that push has been going, as Friday is going to be our end of month wrap up for our Friday morning stream. So TNX. So we're going to look at monthlies today as we sort of approach this wrap up. So daily, obviously a pretty bearish daily candle, not threatening the trend at all. Weekly, relatively bearish weekly candle. Looks like a rejection for now. Does it mean it's a macro top or just something like this? Well, we don't know. We did just get a hard buy. Knife is pretty high. Bunch of green histograms on top of the slope line. Looks like this wants to continue on the weekly rather than have any kind of like meaningful pullback. And then on the monthly, again, very, very strong on the monthly. 2 days away from this monthly close. So, right now, does this candle look bearish if it was to close right now? No. Is there, could we sell off all the way back down to 3.26 or something like that and then it looks bearish? Yeah, I would say so. I mean, we had a pretty hard couple rejections or, consolidations here. And what happened? Well, I mean, we shot up after that. So in my opinion, none of this threatens the trend. Still very much in the bullish control zone. All green histograms, blue slope line. Very, very bullish chart right here. Matter of fact, when we close this monthly, we're probably going to see the 200 simple flip bullish right here for the first time in the 200 simple was still bullish for a little while up until about 1991. So for the first time in about 30 years, we're going to see the 200 simple flip blue and bullish on the monthly, regardless of what happens on this monthly candle in the next few days. So in my opinion, the yields still extremely bullish, which means bonds still bearish. I mean, still bearish. There's nothing that tells me US, this is the TLT 20 year, but nothing tells me they're ready to rally anything meaningful. It looks more like every chart that I look at, basically with a breakdown that just rallied, basically looks like they broke down from key support and back tested it, and now looks like they're likely to get rejection. So let's look at oil. Okay, so oil had a meaningful rally based off of this news. It's been getting straight up beat down for month after month after month. So what happened? It kind of hung out yesterday, and then it rallied up big today. 5%. It was huge. Where did it rally back to? Well, previous level of support that it broke down from. Obviously key important areas. Does this change the trend at all? Are we still below 200 exponential and it's red? Yes. Are we still below the 200 simple and it's flat about to flip red? Yes. Are we likely at some point in time to get a back test of a 200 exponential and 200 simple? Yes, again, so many yeses, which is like a 20% rally. If it just happened right now, we would rally 20%. But likely that's the final confirmation before the bear market. So that being said, is this going to be a 20% rally? Are we just back testing resistance and then we're going to roll back over and then eventually later on we'll have a rally? Well, we don't know. We don't know. We know this is a key level. So obviously if we can get back above this key support level, which is $83, that's very important. If we get back above $83, we'll start paying attention. We'll start looking for that potential 20% rally, etc. That's just a couple dollars away. But when we zoom out and we really, really pay attention, what is actually happening on this chart, the story is very, very clear when we start looking at these longer term time frame charts. When we start looking at daily charts or weekly charts, it can get a little confusing or misleading. Let's look at this monthly oil chart right here. What's the last 4 months? Complete measured meltdown. Anybody that looks at this and sees these moves on oil and says, that looks natural, normal, not to me. I mean, 4 very, very similar candles in a row, you know, in the chunkiness of them. Back down to the 21, almost to the 200 simple, 200 exponential, a little lower. So we had 4 month sell-off. So do we get a month rally now? Do we get another month sell-off? We don't know, but all I see is 4 months in a row of bearishness back into support. So if we find support here or at like $73, that would look normal. If we find support around $64, that would look normal as well. But this is a hard sell signal. Stokes powerfully angled to the downside. 3 red histograms in a row. And we lost, well, we're close to losing support of the 21. So again, we have a very clear target, which is just our next stare down, 73. And then the next stare down after that of 63. We have a very clear target to rally back up if we backtest the 8 on the monthly, which is about 92. You know, and we talked about the potential for a pushback up on shorter time frames for that 20% move, essentially just to backtest the 200s. But this still looks very, very good long term. It's reclaimed the 200 exponential and simple, backtesting it for support, likely followed by continuation if it holds. But it doesn't mean that it doesn't take another 6 months to bottom out back here and give us plenty of buying opportunities. This, to me, the recent price action changes absolutely nothing on the chart when you zoom out and look at it. It looks exactly the same. So let's look at the Dow now. So again, we broke down from this key support on the Dow Industrial Average. And what happened? We consolidated below support. The market looked like it was ready to break down. But what happened? This was the first thing that told me didn't look like we were going to break down is we basically had, whenever you see a similar situation like this, like a top or a bottom, when you see we move up to a level and then we gap down, you know, and then maybe we gap down, gap back up, and then we gap down, and then we push all the way back up, and then we gap down, and then we, you know, gap up, and then we push down, and then gap back up or push back up. You know, basically we're consolidating at this level. We're either going to break through this level powerfully or get rejected. We don't know which one, so we could look for signals. But this is the same type of situation. When you see natural movements in the stock market, most activity happens during open, like while the markets are open, not during extended hours. So when you see like 3 or 4 candles in a row like this, where basically we're right here, we close right there, we gap down, we push down, then we gap all the way back up, then we sell all the way back down, then we gap back up, and then we push all the way up. It's basically telling us like the market is trying to find support at this level the same way it was finding resistance at this level. Now it's possible we lose support here. It's possible that we rally off this, but the market is trying to rally off this level. So when it backtests right here and backtests the previous lows, we know it's an important area. If we reclaim this area, you know, we can start trying to build some kind of constructive bullish pattern back up after this just meltdown. But right now, I mean, realistically, what happened? Well, we came down here, put in a low. We rallied for a couple months leading into it. Very, very clear, very predictable. We topped exactly where expected. Very, very clear, very predictable. We called for a retest of the lows. You know, we called to sweep the lows, basically, potentially put in a new low. And then at that point in time, we need to pay attention to, do we double bottom? Do we break lower? That was the 2 situations we've been talking about. And now here we are going into the monthly. You know, daily, obviously, we're at the lowest areas. You know, it's pretty beat down. When we look at the monthly, though, this really gives us the big picture. I mean, this was our rally that we got off the lows. So sure, that was cute. It was a cute rally. It was cute. Couple percent in one day. Great job. Cute, like a cute little bunny. I mean, is it anything to write home about? Or, I mean, this looks terrible to me. This looks disgusting. We're 2 days away from literally crossing the 821, confirming and closing a new low on the Dow Jones, a new cycle low. With there's still some support below us. It's not like we're just gonna melt down to nothing. But this to me is terrible. I mean, this monthly candle is disgusting. We rallied up and got rejected horribly, and we have just melted down since then. So we have 2 days left. In order for this candle to at least look mediocre at best, we need to rally all the way back up to 307. So we basically need to have, what, like 11? We need to have like a 3.5%, 4% rally, something like that. So like, what, 2% a day till the end of the week? Is it possible we do that? Yeah, definitely. I think we could do 2% Thursday and 2% Friday. Close the monthly candle back here at like 306, 307. I don't think that really changes anything. But the truth is, when we look at this chart, we need to remember we're 2 days away from a disgusting close on the Dow Jones. I mean, this is, if we look at all these red candles that we've had over the last couple of years, this is the biggest red candle we've had so far. And that was losing the 21. And then this is the second biggest red candle we had. And this is the 821 getting ready to cross. So in my opinion, what I think will happen, let's just say I'm right, okay? Let's say we close below 307. And that looks bearish, and the 821 confirms a cross down. Everything looks bearish. We start to just immediately sell off. Everybody's like, oh, this is terrible, blah, blah. Then we rally back up again, maybe. Come all the way back to like 318, 319, 320. Back test it one more time. And then if we get rejected again, then we melt down. That seems possible. Maybe the rejection already happened. Maybe it's still coming. I think with the end of a quarter, there's a lot of people locking in gains, taking profits, moving money around. I think at the end of the quarter, it's very possible, very likely that going into the fourth quarter, we have at least an attempt to push back up here, then maybe a meltdown, then possibly a year-end rally, something like that. That's just a guess. Obviously, we'll see how it develops over the next few months, but right now, this Dow Jones chart is the worst it could possibly look. The first step it could do to not look like total trash is rally up to 308 and close the month above this low right here. We do not want to see a new lower low. That is the most important thing. Hard sell, left the bullish control zone. Stochs have been melting down. All red histograms, red slope line at the zero line. Do we get a bounce here? Do we get a bounce once we get down here? Do we get a bounce when we get down here? I mean, probably a few along the way, but right now there's no reason whatsoever for us to be getting bullish at all on any of these risk on markets. You know, in my opinion, based on technicals. You could be like, but, UK pivot, Japan pivot, and, you know, there's an unspoken rule that once 3 central banks pivot, the Federal Reserve, you know, gets trumped and then they have to pivot too. Okay, sure, that's fine. I mean, whatever. You make up whatever you want. Well, if the stars align and Elon's correct about the, you know, location of, you know, the dark matter in the universe, then according to the trajectory of the sound waves that he beamed into space, I mean, that's all hocus pocus bullshit as far as I'm concerned. Let's look at the technicals, see what they say. Let's look at the SPY. We broke down from key support, put in new lows. We're trying to reclaim that support. If we do not reclaim these lows back here, we're going to go lower. As a matter of fact, we just put in a new low. So we have a high, a low, a lower high, a lower low, a lower high, a lower low again. So more likely than not, what happens? We either continue to the downside, hit the measure move, or maybe we rally back up, put in another lower high again. Not crazy to think. We melted down, we rallied up, we melted down. Do we rally up here and put in a lower high and melt down? Do we rally up here and put in a new higher high and continue up? Do we just straight up melt down? We don't know. The indicator oscillators are pretty beat up. You know, we talk about all the time the importance of, you know, not only obviously daily, weekly, monthly, but the quarterly closes are so important. And a lot of people don't realize it. You know, Friday is our close of our day, our week, our month. We have our quarter. There's options contracts expiring. I mean, there could be a crazy amount of volatility in the next 2 days. But the fact of the matter is, we know what needs to happen for this monthly candle to not look really bearish. We know exactly what needs to happen. We need to, at absolute minimum, on the SPY, on the S&P, rally back to 375. We're at 370 right now. It's not crazy to think, we have a 2% rally or whatever. It's not crazy. But that's what needs to happen. That's what needs to hold. And, it's not like the bears are just going to like sit there and not do anything. It's not like the bulls are going to sit there and not do anything. There's going to be a battle. There's going to be a bunch of people buying, saying, okay, this is going to rally back up. We're not going to close a new low. We're going into the fourth quarter. We've been getting beat down. So we're going to see at least a few percent rally, or maybe double bottom, whatever people are saying. There's also going to be people on the other side of it saying, okay, look, we're getting ready to close a new lower low candle. I'm going to front run the rest of the market because the second we confirm this 821 bear cross, the second we confirm new lower lows, the market's just going to start melting down. And I don't want to be positioned, for new highs if we go to 350 or if we come down to 325, etc. All red histograms, all red slope line, blah, 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 blah. You guys know, so I don't need to repeat myself. When we look at the Qs, we didn't quite make a new low right here. That is good, obviously. This is obviously people trying to position, as they would expect, small cap profitless tech to like lead us out, aka growth, as we like to refer to it. So people try to position in, a lot of the technology space, etc. They've been beat down, so there's quote unquote more value there. Now, keep in mind though, if something is $100 and then it goes down to $10, just because it's $10 now, it doesn't mean it's a great value because it's down 90%. Because it might just be a $1 bill and just people are stupid. So like if I was selling a $1 bill for $100 and people are dumb and they're buying them, that doesn't make the $1 bill worth $100. It just makes people fucking stupid. It doesn't change like laws of like physics and like common sense. It just means there's people that are fucking stupid. So maybe I signed it Elvis and they were like, oh, this was signed by Elvis, so it's worth $100. Maybe I told them it was limited edition. Maybe people are just dumb as hell. Maybe they don't speak English or know, numbers. I don't know. But I mean, that happens all the time. Happens all the time in the crypto space. You sell people a dream, something's worth a ton of money. It melts down and then people think it's a good deal. But it can go down 99% indefinitely forever and it never goes to zero. So the Qs, on the weekly, we're back testing key support right here. We're in between the 200 exponential and simple moving averages. And we flip over to the monthly. We basically broke down, back tested, tried to save the trend, confirmed a bear cross. Looks like we're headed lower. We got steps along the way, obviously. The next big, we got a little step down here on the monthly at 268. We got a big step down here at 219. So, what happens if tech goes down to 219? What happens if the Qs drop another, 20, 25, whatever percent? Are people going to say, well, now they're a good deal? It was a really good deal when it's down 30%, but when it goes down another 20, now it's definitely a good deal. And then what happens from that? We consolidate, bounce around, people say the bottom's in, and then, we drop another like 30% down to 200s. And then, oh, well, now everything's a great deal. If you loved it at 300, you got to be going crazy for it at 150, right? These same people, these same analysts, will continue to say the same thing over and over again. The most important thing for us to remember right now is there is a good chance, there is a legitimate possibility that what we're going to be correcting or what we're in the process of correcting is this right here. There's a very good possibility that we are correcting a 1,531% rally that went on for 5,171 days. And we haven't had the 821 bear cross on the monthly this whole entire time for 5,171 days. And now here we have it. And the last two times we have it, what happened? Well, right after we had it, we then saw a continuation to the downside of about 70% sell-off. 70% after that cross happened. And then here after this cross happened, this is 2008, obviously, another 42%. So, let's average it out. Maybe 40%, maybe 70%, we'll call it 55%. So, probably 55% drop coming. And you're like, but what if you're wrong and it doesn't drop 55%? Well, we can buy it back anytime. Right now, we're at $279. So let's just say right now I was going to reevaluate this and I was going to say, okay, there's a good possibility we're going to drop 55% to the downside. So where would I have to buy the S&P at, or I'm sorry, the Qs at, to know that it was a 1-to-1 risk-reward ratio? Well, I could wait until it gets all the way up here. I could literally wait until Price gets all the way to $431 from 278, and that would be 55%. So if I'm expecting a roughly, 40 to 70% downside, we can flip a coin right now and say, well, you know what? I'll just flip a coin. And, if we go to new highs, I'll be wrong. And if we go to, that 55% downside, I'll be right. Or vice versa. You could flip a coin and pick the highs, pick the lows. It doesn't matter, whatever you want to do. But the fact of the matter, the risk reward ratio is disgusting right now. Something we've never seen before. Because obviously for here, and we go into a blue sky breakout, you can just buy at 400. So in all reality, if you were going to look at risk reward ratio, you would just say, okay, if we close a new monthly all-time high, that's 43%. So, is there 43% worth of danger to the downside? For me, it's common sense. The risk reward right now on these situations is basically, hey, do we do what we did the last 2 times we corrected deeply and we haven't corrected in, whatever we said? Basically from 2009 to present, 13 years without a legitimate correction. I don't know. It seems so obvious to me, and I understand there's a lot going on right now, and people are confused, and they feel that FOMO, and they see stuff jump up, or they're afraid they're going to miss the bottom. Just trade the trend, And right now the monthly trend is starting to look disgusting. So IWM, Russell. Obviously the Russell bounced the lows again. We talked about here how it was holding up better. So when it did melt down, it was going to be bad. And it was. It melted all the way back down to the lows, but it did it way, way faster. So when we flip out to our monthly, again, we're not even seeing enough daily signs to tell us this is likely a bottom. When we flip out to the monthly, we see, this thing has, if we drew in the 200s all the way back, basically we get the cross, we hit the 200s. Here we get a false alarm. Here we get, a little front run. We get the cross. We're likely to hit the 200s. Now we are holding above support. I guess it's okay. For me, the Russell and the NASDAQ are great and everything, but the SPY and the Dow Jones are what move markets. And they all look terrible right now. The SPY and the Dow Jones look even worse. Dow Jones looks worse than anything, and that's really the indication of like the actual economy, a little less speculatively. SMH, at the lows, hanging out. Again, when we just look out at these monthly candles and we say, okay, what does this really look like? I mean, this looks terrible. Same thing. We've been rallying up since 2009, haven't corrected, and now here we have a bear cross on the 821. I mean, I don't care what anyone says. If you don't think we're going to go down here, that's fine. But right now, the responsible thing to do, if you don't have any capital, or you're like young, like do whatever you want. Who cares? Do risky stuff or whatever. But I mean, if you're like a middle-aged adult or especially older, if you have a decent amount of capital or whatever, if there was ever a time to buy, insurance, it's right now. I mean, just imagine you're in a plane crash. The plane's crashing to the ground, and then all of a sudden, the stewardess comes on and she's like, hey, if anybody wants to buy life insurance to make sure that your family is taken care of in the event that you don't survive the plane crash that we're in the middle of, just click the box on the screen. That's basically what the market's saying right now. Hey, things look like shit, the worst than they've ever looked. It does look like the plane is probably going to crash, and we're probably correcting something like a 13 to 40 year cycle, possibly even, 90 and 100-year cycles. So that's probably happening, but maybe not. So if you want to buy some life insurance right now for pennies on the dollar, you still have time. That's all I'm saying. Now, could that life insurance expire worthless and you lose your pennies on the dollar? Sure. 100%. 100%. And I won't just disappear off the internet, and I won't just be like, oh, I'm always right. I'll be like, man, I was really wrong about that one. It's crazy that, the Fed pivoted. I guess that old, 3 central banks pivot rule is true, and I just didn't know about it. Whatever. XLE, so we talked about this. We expected it to come down here and try to put in a higher low. We're back testing the 200 exponential and simple now. Obviously, we're looking for the potential for a breakdown. This looks very clear to me like a high, a low, a lower high, and then we're likely to get a lower low. The key areas we're watching still like 55. This little rally back up on energy, this is what people got excited about. Absolutely blows my mind that we could have like this little candle after like something's been melting down and people get this excited. It absolutely blows my mind. Hard sell signal on the monthly, leaving the bullish control zone. We only have one red histogram technically, so that's a good sign. We're about a day and about 2 days away from the monthly candle closing. Now, is it terrible? I mean, no, there's definitely worse out here. You know, if it closes above this low right here, that's good. Because we have a high, we have a low, we have a lower high, but we don't have a lower low. If it closes below like 71, that's not good, obviously. But the truth is, we already backtested the 200 simple. So maybe we hang out here a little bit. More likely than not, we backtested 200 exponential. Like, I mean, it's 57, so maybe we front run it in the mid 60s or something. But likely we push down here one more time to at least the 21, at least try to test the 200 exponential. And then after that, I could potentially get bullish, but not right as we're getting the hard sell signal, as we're leaving the bullish control zone. We talked about this a bunch of times in advance. Here we got the signal. It rallied up a little bit, double topped, and then melted down to 0. Here we get the signal on the monthly, and it melts down for years to come. Here we get the signal on the monthly. It melts down for about 6 months and a pretty deep correction. Here we get the signal on the monthly, and it melts down disgustingly low for months after months. Here we get a false signal because we never leave the bullish control zone. We know that's obviously a criteria. Everyone knows until you leave the bullish control zone. You know, it's great to leave the bullish control zone. It's great to get a hard sell signal, but you need both to validate the signal. And this is a perfect example why. So obviously we see that was a false signal because we didn't leave the bullish control zone. We wouldn't have gotten tricked by that. But every other signal has resulted in a pretty disgusting sell-off. So again, you know, for me, it's easy. You know, just stick to the obvious stuff. We don't have to try to get, you know, fancy with this stuff. You want to talk about fancy, we'll talk about the quick little, the Bitcoin $1,000 candle and then the meltdown afterwards. That's fancy. XLU utilities obviously melting down. We hit the measure move. We talked about the double top, the M shape, you know, double top M, broke through the neckline, measure move down here. We took us to the initial level, 200 exponential and simple, took us down back again to our other key support level. So breaking down from that support level now, I know we have a lot of stuff on here, but we have a fib that lines up roughly with the ascending support channel somewhere down here in this like $67 range. I would assume we're just going to hang out in this channel longer. I mean, when we zoom back here, it's like, oh, what are the chances that we break the channel meaningfully? You know, like, I don't know. When I look back at a channel and I say, okay, we've been in this channel since 2008, and we've either hung out in the top most of the time or the bottom most of the time, and sometimes we've poked our head out the top, and sometimes we poked our head out the bottom. But in the end, we pretty much always operate in this channel. For me, I'm going to go ahead and buy support when we get down here. Could it break? Could it melt down? Sure. But, you know, I'm going to just assume based on the like 4,000 other times that, you know, we hit the top of the channel, bounce off the heart line, hit the bottom of the channel. I'm just going to assume that we're going to just keep doing the same thing we do. Now, if and when we melt down, is that going to be a great opportunity? Sure. But for me, I'm just sticking to the easy stuff. When we zoom out here and we look at this monthly chart, you know, we're starting to see, you know, not great. This to me on the monthly chart looks like distribution taking place. You know, we have 1, 2, 3, 4, 5, 6, 7 months now in a row where utilities hung out at this level and could not break to the upside. And now we're slowly but surely coming lower and lower when we retest the downside. So we put in basically a hard top right here. And then each time we hit that hard top, we're coming down a little lower. So it's like, okay, well, if we're building up momentum, are we building it to the upside? No, we're hitting the same top every time. Are we building it to the downside? Yep, we are. So how long before we break down through that, you know, maybe come down to like that 65 range? And then how does that line up with our potential targets for like the bottom of the channel or these key fib levels, etc.? So, you know, we didn't quite hit the 1.236, which was the target up here. But right now, what I'm seeing looks like there's a little more downside. We are getting a hard sell. We didn't make it all the way up into the bullish control zone, but we do have a hard sell. We do still have a lot of green histograms here and only a couple red ones. So I don't want to get overly bullish on utilities right now, but a lot of this stuff, and I get the narrative is like, no, utilities are going to go up and that's safety in a recession. And, you know, I get it. Utilities could rally tomorrow. All of a sudden the risk on trade could go right back off. And then all of a sudden utilities rally. We know any of the safety trades, when we flip back and forth to risk on and risk off, probably are going to sell off like counter to the markets. So utilities has been safety. So now all of a sudden it's struggling when we see a rally. Excuse me. When we see the rally. But look, this isn't a one-day situation. Utilities didn't just start selling off when the rest of the market's going up. I mean, this has been melting down. So it's very important we pay attention to like the longer, term trend and what's going on in the longer time frames. Let's talk about consumer staples as well. So we talk about this key level on consumer staples. Obviously, this needs to hold up, and it should. Doesn't mean it's going to, but it should. It was support all through this time when we come up here. And now this is just basically looking like, it's an ascending, broadening wedge in a sense, but the wedge is broadening, but the wedge has a flat bottom to it. So it's sort of like a descending triangle being put in backwards. Normally you would peak out and then you would just put in lower highs and the same lows and form a descending triangle. This is like, we're building into this descending triangle from the wedge portion of it, and then it's getting wider and wider and wider, but we have that same kind of flat support line. So we still treat flat supports and resistances the same way. The more times we hit them, the more likely we are to break them. So while we're continuing to put in, higher highs, and that looks good and everything in the time being, then we start putting in, a confirmed lower high and lower lows, but really that same support's holding up. This looks to me like it's getting ready to break the same way a descending triangle would. Now, it doesn't mean we don't rally back up here again to like 72, 73, but eventually it looks like we're coming down to 65. And it might just happen now. I mean, we've hit this support quite a few times. It's a pretty clear support, and obviously it held nicely. But the truth is, at some point in time, the market is going to respect what's happening here more than what is happening there. Now, we don't know when that's going to be. Obviously, I don't know. We see a cluster of resistance through here. We see some support, obviously, at the bottom, resistance here at the top. So it seems likely we're coming down here to tag our green box right around that level. And there's enough confluence there. We could buy that for a reaction bounce. Maybe 10, 12%, something like that. Let's zoom out and look at the monthly here real quick. I just want to look at these monthlies ahead of time. Like, it'll be great to look at everything on Friday and see how it's about to close and stuff. But I want to look at them ahead of time and be kind of prepared, because some of the charts look really bad. Some actually don't look that bad. So XLP, Consumer Staples monthly, we're still a little ways away from the 821 cross, but this is pretty bearish right now. We have left the bullish control zone, hard sell, Stokes powerfully angled to the downside. Knife is headed down quicker. Bunch of red histograms below the slope line, still well above the zero, but looking like some further downside in the cards. And we see here this previous top right here lines up at that same like 63, 64 level. So that does seem like a very, very likely target to me right now. So XTN, transportation. So obviously transportation melted down to new lows. Looks like we're back testing what was support as resistance. If we reclaim those levels, we could start looking at previous, obviously the 8 now, then the 21, then, the 200s. Seems more likely to me that we're headed to lower prices. We know obviously we have a big macro picture on, we have a big macro picture on transportation. So obviously, we have this descending broadening wedge going on here. Hasn't been perfect. It's been pretty good. We kind of like got rejected a little early right here, but played that nicely. We kind of like front ran it a little bit right here, but we see the 236 and the 382 in blue and green respectively, as well as this yellow support line, which was the previous highs from 2018. Obviously, we didn't quite get there in 2020, but that is a pretty strong area, and that's basically our back test. So we need to reclaim this very, very strong, what was support, but now is resistance at like $69. And if we don't, we're likely going lower. So 0.5 or the 618, 382 levels, right down here about $52. And we know every time, one of these big cycles plays out and we break down from the channel, we go into a long transportation bear market, a long, painful, slow bear market. Same thing right here. Long, painful, slow bear market, and then we break down from the channel here. We take a little longer to top out. It pulls a little Bitcoin move right here, and then long and slow, gradual, just meltdown. So, what does this say about the whole scope of everything? You guys know, obviously, the most important things, for me, are, the cost of capital, obviously, rates, very, very important. And then food and energy, aka energy for people and energy for growth of the human race. Those are obviously extremely important. And we know transportation is essentially realizing, that energy for its purpose. So if we see transportation slowing down, or we see semiconductors slowing down, or we see rates continuing to rise, or, QT taking place over QE, we have to understand that the environment is different. And I know you guys all do, but there might be somebody new that's listening right now, that isn't as keyed into the markets as we are. We have a huge advantage because we have such an awesome community, so many amazing people, like after growth, personal, financial, etc. And honestly, we all feed off of each other. I mean, seeing the amount of responsible trade setups that you guys post, I mean, some are still trash, don't get me wrong. You guys are definitely some bottom feeders. What are those called? You're like Plecostomus, the like sucker fish that come around and like eat up all the algae. Don't get me wrong, I do my share of it as well. I mean, come on, I talk about pot stocks. They're obviously garbage. But the truth is, at least you're like trading degenerate assets, but doing it in a responsible way. So in a way, that was a backhanded compliment, but it was meant to be good. So just blessed to have built such an awesome community. So that being said, DXY, there's not a ton to see right here. Obviously, we saw a pretty bearish candle. It's getting a little bounce right here. Essentially, what is this? We saw this happen again recently. Remember when everybody hiked their rates like a week or two before the Fed did? We saw some weakness in the DXY in relation. Why is that? Well, if the Fed doesn't change anything and all these other countries hike rates, then that makes their currency stronger now in relation to the Fed, even though or into relation to the dollar. So then the Fed came out afterwards, they hiked rates, and then the dollar went back to parabolic again. So we just got back to where we were at before. So obviously, if it looks like all of a sudden, there may be a pivot, or there's going to be some QE going on, or some kind of stimulative situation like the tax cuts, etc., in the UK or whatever, you would expect the pound to strengthen up a little bit. You would expect potentially other currencies to react accordingly. You might see the Canadian dollar rally in relation to this more than the US dollar does, or vice versa, etc. So it's all relative, really, but this doesn't change anything. We're still inside the bullish control zone. We do have a couple red histograms on the daily. We did see a pretty violent sell-off right there, bearishly engulfed a couple candles before it. But we're still above the 8. That's fine. We know, obviously, the 21 is where we start paying attention. We have some horizontal support levels as well. When we zoom out to longer time frames, nothing has changed here. I mean, the weekly chart, we see a little bit, this looks like a potential rejection candle on the weekly. We'll see how it closes. Obviously, 2 days left. Maybe we see continued weakness and it does look bearish. Maybe it just continues rallying up. The actual chart, though, is extremely bullish. 200 exponential above the 200 simple. Hard buy signal into the bullish control zone. Stoch still angled to the upside. Bunch of green histograms, blue slope line. This is still a very, very, very powerful trend. And then when we look out to the monthly, I mean, this is our candle that's about to close in 2 days. There would have to be some disgusting price action for this candle to not look amazing. I mean, imagine if it sold off down to like 111 and half the candle was a rejection wick. There would still be a giant green, body on the candle. So, I mean, it would have to get really, really nasty in the next couple of days. And keep in mind, this is obviously a monthly chart. From where we enter into, or exit rather, the bearish control zone and enter into the bullish control zone, like 9 months go by. And then from once we're in the bullish control zone to when we exit and get the hard sell signal, that's obviously like a year taking place right here. So could this be the end of it? Could this be the end of the trend? It's possible. But I mean, this is a parabolic uptrend. I don't want to try to call the top of this thing right now without even a candle. The candle is the least reliable first sign of like, hey, something's going on here. We look at the candle. Then we look at candlestick patterns and we say, oh, well, when we take like 3 or 5 or whatever candles and put them together, now we have even more indication of what the market's thinking and potential of what's to come. And then after that, we can look at like outside of candlestick patterns, more like chart patterns, which are like, a head and shoulders topping pattern or a double top or something like that. And then we have even more price action to look at it. And then we could look at our momentum oscillators and indicators and all that. And then we could say, okay, we have a bearish candle that turned into a bearish candlestick pattern that turned into a bearish chart pattern, and now momentum is building back to the downside and there's just so much bearish stuff and just fuck the dollar. It's garbage. But we don't see any of that right now. We don't see any of that. All momentum, everything scream. We're in the bullish control zone, all green histograms, blue slope line, 821 across the upside, 200 exponential above the 200 simple. Everything bullish. Everything bullish. We have a cluster of resistance right here. I don't expect it to just shoot straight up, but, it's a cluster of resistance. We spent, a year at this level. When we zoom out and we look at the lines everywhere, colorful puke chart, we know obviously this is that key area we've been watching. This is the 886 from the top here to the macro bottom. And we know The 786 is the last line for pivots usually. The 886 is resistance, but very, very rarely, very, very rarely do we see the 886 act as a reversal point for a trend. 786 is the last line of reversal or like double top, in my opinion. I mean, 886 has reverse price action before, but very, very, very unlikely in my experience. So that's what I'm looking at. You know, I'm still looking at a very powerful DXY chart right here. I'm looking at very bearish, you know, risk on asset charts right now. And I don't see anything changing. What's going on, Toby? Good to see you. Fire session. What's your take on growth stocks such as Walmart or Target as growth stocks? I don't know. Do you consider Walmart a growth stock? I mean, I guess you could make an argument for Target. Though, I mean, I consider those like more like defensive stocks. I mean, I don't know. I guess it depends how you look at it. I mean, sector-wise, you know, they're in consumer staples. So, well, I guess arguably Target is a little more, it's a little more like discretionary, I guess you could argue. But no, I wouldn't call them growth stocks at all. I would call, I mean, Target's in a weird spot. I would call them more of value stocks, honestly. Walmart specifically. I would call that like a value stock. What do I think of it? I think it's decent defensively. I think consumer staples in general are good defensive in a recession or depression. But the truth is, here's the weird situation that people have to realize, is that if we do in fact go into like a recession or depression, this is going to change big time. Because most of the time when we go into a recession or depression, we have super low rates. So the whole like TINA, there is no alternative, or, you know, whatever, that's not the case this time. Like, let's just say right now, like all of a sudden, you were like risk on 100% in the markets or risk off 100% in the markets. So you're getting ready to like deploy some cash. If we start going into recession, rather than just buying stocks, like defensive stocks, you're more likely than not probably just going to buy bonds. I mean, the truth is, like, let's be real here. If you're going to get roughly 2.5% from the S&P, you know, based on dividends, versus 4% from a bond, I mean, that's like a no-brainer to me, especially if we're going into like recession or tough times or whatever, because likely stock market's not going to perform that well because it's probably a risk-off environment. So then really people are going to run to fixed income. And then on top of that, you have all the demographics. You have like a massive boomer like generation, like literally retiring at like 10,000 people per day in the United States. That's a lot of people going probably to risk off already. So if you add that with everything going on right now as well, I think that there's probably going to be a big boom in the fixed income market. You know, treasury bonds, you know, some junk bonds and shit like that as well. But U.S. treasuries seem like the no-brainer move. The only question is timing, okay? Because a lot of people tried to time the treasury market not that long ago and got absolutely destroyed. Matter of fact, they're still bent over, barely alive. Accounts probably blown out worse than their b-holes because they've been getting fucked. Because they try to call the bottom on the bond market and they were wrong because they're morons. And we've discussed it a bunch of times why this is what's melting down people's brains. Why is the bond market doing so bad in the United States, but the dollar is so strong? Because what is the bond market? It's just a promise of future dollars. So the DXY is strong relative to all these other currencies, but the actual bond market is not strong. And people don't understand why that is. And the truth is, when you're in a rising rate environment, nobody wants to buy bonds. Because here's basically the worst case scenario, okay? Worst case scenario. Because with bonds, people don't understand this. I swear to God, I've seen like 100 people make a bond video and they don't fucking understand how bonds work. And they're trying to explain it to everybody else, which is probably why nobody understands how bonds work. You are basically contracting with the government. You guys are filling out a contract together and you say, hey, I'm going to give you this money as a loan and you're going to pay me back that money at the end of the agreed period. So you're like, okay, 10-year bond. So I'm going to loan you $1,000. You're going to pay me back $1,000 at the end of the 10 years. No matter what. No matter what. You get back your principal. No fucking matter what. As long as you wait that amount of time. As long as you fulfill your contract. What changes is the amount of money that someone would pay you for that bond prior to its expiration. And it changes because of the real value of the bond itself based on the amount of coupon that payments that you would receive in the meantime in comparison to what a bond and the current rates are for now. So for instance, if I bought a bond for $1,000 and it pays 1% interest, okay, and then the next day bonds come and I'm locked in for 10 years at 1% interest, the next day the rates go up to 2%, my bond is not worthless. It's still worth the $1,000 at the end of the 10 years. It's still worth the 1% interest every year for the next 10 years. None of that has changed. What has changed is the incentive of me to just dump that bond and take a loss on it and then buy the new better bonds. So you're basically discounting the future cash flow from that asset and then adding it all up together. So if I buy a 10-year bond for $1,000 that pays 1% without compounding, I'm not going to compound just for simplicity. At the end of the 10 years, I have my $1,000 back, and then every year I got paid 1%, so that's $10 times 10 years. So I have $1,100 at the end. That's fine. The problem is that if I take out that bond and then the next day there's bonds for 2% for 10 years, and then I say, well, fuck. And then I start figuring out, well, how much am I going to miss out on by not getting the 2% bond? So now you take that same bond, $1,000, you get it back at the end of the 10 years. Now you get 2% per year. So instead of getting the $10 per year, you're getting $20 per year. So then at the end of that same period, without compounding, which obviously is going to make a difference on 10 years. Now, instead of that $1,100, you have $1,200 because of the 2% instead of the 1%. So now someone might be willing to sell that bond on the open market or, violate the terms of that bond or whatever the situation is. They might want to get rid of that bond for $50 cheaper. They're willing to take a $50 loss on that bond, knowing that they can turn around and take that $950 or put another $50 of their own in and then buy a new bond at 2%. So they're basically splitting the difference. So if at the end of the 10 years, you were either going to get $1,100 or $1,200, and I say, well, I'll tell you what, I'll sell you this bond right now at a discount. You still get all the payments in the meantime. You still get back the principal at the end, but I'm going to split the $100 difference with you because I was going to lose $100 by being in a 1% bond instead of a 2% bond. So I'll give you a $50 discount right now to take the loss for me. Everybody wins, quote unquote. So that's the idea. The idea is not that your actual bond just got cut in half or went down by 20% and you're not going to get your principal back. The idea is that time value of money, your money is locked away. And if you're locked away at a shitty percent, it sucks. If there's something else giving you a way better percent. So at some point in time, you pull the pin on that, you pull the ripcord, you eject, and you say, I'll just take my less money and then put it into something else that's paying me better. Because if we take it to the extreme and you said, okay, I'm going to lock in a 10-year bond at 10%. And then you start looking at it and you're like, okay, $1,000 principal, 10% per year, that's $100 per year. So at the end, I get my $1,000 back, plus I get $1,000 in interest. Now I have $2,000. So take the original bond that was worth $1,100, take this bond that's worth $2,000 and say, okay, what am I willing to take as a loss right now to make an extra $900 later? So that's what's going on with the bond market. And I wish people could understand that a little bit better because that's what changes everything. It's not like if you're just going to lock away this money, there's no risk. There's no risk to not get back your principal unless whoever you borrowed from or loaned to rather defaults, which again, AAA bonds should literally be zero risk or the least risky. If you give Michael Saylor a loan, you're probably not going to get it back. If you give it to the U.S. government, you're probably getting it back. So anyway, all of that with demographics is going to drive all these people into the bond market, in my opinion. The question is, do people start locking in at 4%? Do they lock in at 5%, at 7%, at 10%? I mean, it's different for everyone. I'm going to tell you right now, though, if rates go back to 10% for U.S. Treasury bonds, I mean, who's not going to lock in for that? Every 7 years, you double your money. Every 7.2 years, you double your money. Who's not going to lock in for that? Zero risk? Come on. So anyway, and then, obviously what the bond market or the people that are in the bond market don't understand is that the reason the yield curve is inverting is because of the risk danger. Long term, people are like, probably everything's going to be okay. Short term, it's like, who knows what the fuck's going to happen tomorrow. So the shorter term stuff, people are willing to lock in for, but you got to pay them a decent amount for it. The longer term stuff, people are like, yeah, maybe I'll lock in. Probably the world's not going to end. But also, I don't want to be the sucker that locks away at 1% and then tomorrow they're paying 2%. So that's what's going on right now. And that's this crazy struggle in the bond market. It's not like all these bond investors are losing money left and right. Like if you actually purchase bonds, you're safe. It's only the people that are speculating or trading in like the, secondary bond market, etc., that are taking losses or seeing this, or people that are trading, TLT versus actually buying bonds, etc. So, all right, so that's enough of that. I know bonds are boring as hell, but apparently nobody understands how they work, probably because they're so boring, no one will take the time to actually understand. But all it is just a contract. And if the contract terms get good enough, people are just going to take that. If the S&P is paying you 2.5% and bonds are paying you 10%, I mean, come on. Are you going to invest in the S&P and just hope that it goes up by 7.5% and then you just break even? Or are you going to take zero risk and just buy U.S. Treasuries? Well, there you have it. All right, so let's keep rolling here. So good to see you, Kama Betty. What's up, brother? Parag, what's up, man? Good to see you as well. Jay Hoff said, been missing the live streams lately. Glad to catch one. Hey, I'm glad you made it as well, Jay Hoff. All right, so on to Apple. So obviously Apple short setup still in play. We almost got there today. We were like one candle away. It did rally back up to close that gap pretty good towards the end of the day. Obviously gap down there, decent amount. A lot of this is, the new iPhone, potential underperformance, currency head risks for selling outside the United States, etc. Think about it. If the dollar just went up by, 15% comparison to other currencies, you go to buy that $1,500 iPhone and now it's, another, what, 225 on top of that, 1750, 1725, whatever. So you get the point. Apple's got some headwinds, so we'll see what happens. Obviously, we were talking about in the group today, it's hard for the market to go down when Apple is going up the same way it's hard for the market to go up when Apple is going down. So Apple rallied later into the day, had a nice rally actually. But the truth is, I still think it's headed back down here to support. It has been holding up really well, but it's very, very technically driven. Let's look at our monthly chart. Obviously, Apple has just been on a tear for eternity. Did come down here and threaten the 21. We're still above the 21, below the 8. So you guys know how I feel about this. When we're in between two moving averages like this, I consider us range bound. Until we break above the 8 or below the 21, I just think we just chop sideways here. So the real area to watch was basically like that 145 area. And then after that, it's a retest of like 136 and the lows. This does it looks like it's topped out. Hard sell, left the bullish control zone, Stokes power for the angle to the downside. All red histograms for month after month after month, and it's been holding up. Probably is getting ready for a trapdoor. We just dropped below the blue slope line. It is still blue, but getting ready to flip red. So yeah, honestly, Apple is probably getting ready for a pretty big leg down. Pretty big leg down. Let's see where the 200 simple is at. That's probably where we're going, and it's probably pretty low. Yeah, 117 and 108. So 200 exponentials at 117, 200 simples at 108, and we do have a decent consolidation around that level. That's probably where Apple is headed, honestly. I don't think I have that. Oh, I'm sorry. I was about to say I don't think I have that on here, and it's the fucking second trade setup target. So yeah, you guys know what it is. Also, we saw this pretty clear rejection here. Whenever the slope line, obviously come back up to it, we can't reclaim it, and then we get rejected. Usually leads to continuation in that direction. So we do see a little indecision. Weekly is crossing back down. So again, Apple has held up really nicely, but it doesn't mean it's not due. I don't like to be like, oh, I'm going to bet against the horse that always wins the race. But, if you see it limping a little bit or some signs that, something's wrong, it's not necessarily a bad thing. But like any kind of short in particular or bet against a strong player in a market, it's the timer is always ticking. Like, I don't want to be in an Apple short for a year. I don't want to be in an Apple short for months. I want to be in an Apple short for a quick little move down, and then I'm getting out of the way. Same with something like Tesla. So speaking of Tesla, obviously just consolidating in between the 200 exponential and simple. Again, likely comes down here and retests the lows. It's been holding up quite nicely around that 300 level. It's about 287 now. Again, I'm not going to really bet against Tesla. Of course, have been saying that about Apple too. And then, of course, I bet against Apple. So seems very likely to retest 209. And then after that, we'll pay attention. There's a cluster of support all through here. But right now, Tesla honestly is still holding up pretty decent. I mean, it's holding up really good compared to most of the market. Yeah, I mean, still well off the 821 cross. We're in between the two of them now. So it looks to me like Tesla is probably range bound between like 256 and 290 on like the monthly closes. If we do start breaking in one direction, I favor to the downside, obviously. We're below the 200 simple. It's already flipped. We're barely hanging on to the 200 exponential. It looks like it's about to confirm into a bear market and roll over. It's just a matter of time. So Microsoft, we broke down, we lost support, we back tested support. The support is the 382, obviously. So again, this is why it's so important when we're trading against a trend, we have to take profits, because look at this. We ran up 15%, we took profits, it ran up a little higher, and then look at that. We're lower than when we entered into it. So we would have just give back the whole trade, complete round trip. And we'll talk about that with Bitcoin as well. So we see a couple green histograms. It is backtesting the 382. So, if it gets back above this level, we'll start paying attention to 21. We'll start paying attention to that. But we just bounced the 382. We just backtested the 200s. We just lost the 382 as support. Now we're backtesting the 382. For me, next move is to the downside. Next move is to the 0.5. The remainder of the measure move and the 0.5 at 215. And again, I'm going to skip the weekly. We'll just go straight to the monthly. When we look at this thing on the monthly, I mean, it's been going absolutely parabolic. It had a couple little scares right in here in like 2015. Had a little scare right here in 2018. Had our COVID drop right here in 2020. Now here we're seeing something different. Here we're seeing the 8 and 21 are very close to crossing on Microsoft. So again, we're seeing our first legitimate correction in Microsoft in this whole bull market, since 2013. Arguably, before that. But 2013 was our last red cross. And here we have it. The red cross about to take place. So, our typical target is going to be the backtest of the 200 exponential and simple. I'm not saying Microsoft has to go to 113 or that it will go to $82, but I'm saying there's a chance. If you asked me that any other time, I would have told you no, probably not. Well, if we were below it, I would have said, yeah, probably. But once we were above it, I would have said, yeah, probably not going that low. But with the red cross on the monthly, that changes the whole perspective. Changes everything for me. And that's the beauty of a mechanical system like we have, that we just follow the rules all the time, and then every once in a while we break them. But 99% of the time, we just follow the rules, and then it's easy because we don't have to worry about our emotions or our feelings or our opinions or fundamentals. We just stick to facts, hard facts. So Google on the daily, so broke down to new lows, hit the measure move of the channel. So we obviously have our longer measure move, which is our lead in to the bear flag. We hit the 382. We're reclaiming the 382. So we're at support for right now. So, the daily, again, kind of sending us mixed signals. Hey, maybe this is a bottom. We see some bullish divergence on the stochastics, not on the MACD. Maybe this is it. And then when we really zoom out, we look at the monthly. Wait a minute. Does this look like something is bottoming? Does this look like a bottom is being put in? It looks like that monthly cross about to happen. It looks like we're about to close a disgusting down monthly candle. And it looks like we don't have any real support until about $81. Arguably down here at like 73. So is Google getting ready for another 25% plunge? Maybe 20% plunge? Yeah, probably. And so again, once we start looking at these monthly charts again, it's like we can't even pretend to be bullish. Like when I'm looking at the daily, I can pretend. We can make a good case. Some of the weekly charts too. But when I look at the monthly, I'm like, look, I mean, I can piss on you and call it rain. But, I mean, it doesn't make it rain. It's still piss. The difference is whether or not you allow it and whether or not you believe me. So, I mean, I'm not into that weird usher shit. It's obviously very strange. NVIDIA. So NVIDIA breaking down to new lows, well below support. We do have another target down here for slightly lower, looking for an entry scalp around 104. We're at about 127 now. Very pathetic underperformance. Quite a bit of support through this area right here. So I would expect it to kind of chew sideways and bounce around here. It is printing some short-term bullish divergence as well, but I have zero respect for NVIDIA and divergence right now. Just got the cross, a disgusting candle down at support. If we close where we're at right now, it's going to look pretty bad. I mean, we'll still be holding on to support at about 123, but realistically, the next support level is like $69 on the monthly chart. This previous high right here, like $70, $71. We'll call it 69. We'll round it to 69. So $69 is what NVIDIA has to look forward to. Another 50% haircut. But hey, you know, that's 200 exponential and simple. So it doesn't even seem crazy. Actually, it's like, well, that actually makes a lot of sense. And I know these targets are bearish and they're disgusting and we're probably not going to get down to them. Some of them are going to get hit though. Meta, I mean, just a slow grind down to zero. I mean, just the worst chart ever. We're not even looking at Amazon. Amazon on the daily. We did bounce that key level at the 618. So we basically had, you know, we didn't quite get down to the 786. We bounced basically the previous top right here, the red resistance support line. So we bounced out a couple times, came back up, got rejected at the 200s off that double battering pattern, you know, basically got our perfect measure move. And then we rolled back over to the 618. So the next target, if we come down, is going to be 102. The next target, if we go up, is going to be 123. We're at 118 right now. So you have $5 upside or you have, you know, $16 downside. So it's easy to tell where the bias is based on where Amazon is currently. And then again, when we look at this monthly chart, you know, we see obviously, you know, there was a false alarm right here in 2008. Wasn't that bad for Amazon? You know, I mean, I say it wasn't that bad because we're on a log chart, but you know, from the highs to the lows right here in the 2008 sell-off, obviously Amazon didn't take it like it did in 2000. That's 65%. You know, 2000 it was down, you know, 90 and some change. It's like 95%. So 95%, 65%. So, I mean, is it crazy to think that we may still have some downside? Guys, I don't like it. I mean, I really think Amazon comes down to like 85 bucks. And, you know, realistically, you know, 200 exponential and simple. Do we get there? We don't often test the 200 exponential and simple. So if we do get there, it means things got bad. But I'm not going to write off that things are going to get bad. Like, I still honestly think, my honest opinion on the markets is that people haven't really accepted, like, fate of the markets. And, like, I think a lot of people are like, oh, bear market's almost over. Like, we almost survived it. It's fine. Fed's going to pivot soon. I just don't see it. I don't see any signs of it. And I guess, like, maybe I'm a realist or I just believe too much in, like, actual information and data. But I just don't see it. Do not see it. So let's look at Bitcoin on the daily. So, you know, obviously, people are super bullish of the recent price action on Bitcoin. We had that, you know, $1,000 candle. We had another, like, you know, $1,000 price action off that. Look where we're at, though. We're at the lows. We're at the lows. This is an all-time high, and we're at the lows. There's nothing bullish about this to me. The longer we hang out at the lows, the more likely we are to get trapped forward. So it's good that we got back above the 8. That is a good sign because we haven't been able to do that, you know, since September 9th, rather. It's good. It's a good thing. Good job, guys. We did it. So daily, you know, bullish divergence. Got back above the 8. Hard buy signal. You might be thinking, hey, this actually looks okay to me. At support, maybe we should be buyers right here. Sending mixed signals, in my opinion. When we go to the weekly, how does this look? Well, we have the 821 cross down. We're below 200 exponential. It's red. We're below 200 simple. It's flat, about to turn red. We're in the bearish control zone. We're about to get a bear cross into the bearish control zone. Bunch of green histograms, red slope line below 0. So we have a bunch of green histograms. That's good. That's it. Still blue slope on the 200 simple, but it's flat. So it's just, it hasn't turned red yet, but it's about to be red. Doesn't look good. Below the 8. Rejection off of the 8. At new lows. Consistent lower highs and lower lows. This looks absolutely disgusting to me. But we're up. $1,000 off the absolute low. That's good, right? Right? And looking at the monthly, I mean, you know, obviously we've been talking about it now for the last couple of months. The key is to not take out 20K to the downside on a monthly close. We're there now. We have 2 days. I'm confident that, you know, the Bitcoin bulls can rally that up. Now, are they going to be able to when the bulls are defending? I don't know. I mean, I think there's enough Bitcoin bulls right now that they could push the price up $500 if the bears allow it. But the question is, you know, there's going to be a bull side and a bear side looking to print this candle, looking to, you know, quote unquote, paint the tape, so to speak. So if they paint the tape as a new low, it looks really, really bearish. And, you know, we head down to like 16.5 and then 14. If the bulls win and paint the tape, you know, it just looks like one more bad candle, but not worse. We just right now, like good for Bitcoin is just not to do more bad things that it hasn't done yet. So in this case, the more bad things would be to put in a new low. That's not cool. Bears are in control. All red histograms, red slope line below the 0 line, 821 across the downside. If we had a 200 exponential and simple, if Bitcoin existed long enough for that to be possible on a monthly, we would be above that and it would still be blue. So that is good. But that's it. That's it. We have to go to a monthly chart and look at a moving average that doesn't exist yet because Bitcoin hasn't been around long enough to find something bullish. So I guess I don't have to tell you how I feel because the charts do it for us, and that's the beauty of it. All right, so let's talk about this recent little pump here and what was going on. So we were able to capitalize on this $1,000 candle. You know, it was only like 4% or something like that. It's not like we got rich off of it or whatever, but it was like 4% in a couple hours, which was nice. And we caught it like perfectly. All we were expecting was as soon as this 821 cross happened right here, there was some various other momentum indicators showing up. So we decided to take an entry at this level, basically on the back test of the 821 cross. It was at like 19.2 or something like that, 19,000, somewhere around there. And then it just literally shot up immediately afterwards to exactly our target. We're expecting a back test of the 200 simple and 200 exponential, so 20,200. So I posted up a little in advance, hey, get ready for that $1,000 candle or whatever. And then obviously hit it right away. Took profits. I actually took profits closer to like 20,000, like 100. Might even been just under that. But regardless, I'm locking in gains. I mean, I don't have to explain it to you guys. You already know. The knife was through the roof, as we had noticed, and you know, one of the members pointed out as well. Very, very unsustainable levels, saying that we had already topped or we were likely about to put in a top, and then obviously got rejected off 200 exponential and simple. This was a pretty bearish 4-hour candle at that point in time. It's pretty obvious you got to get the hell out. And then obviously we made new lows after that. I didn't re-enter. I didn't see anything telling me that I should be re-entering or momentum was going to shift or whatever. I figured this was the big chance for Bitcoin to rally back up for the monthly close. And then we were probably just going to kind of hang around on this level, but didn't trust it. And obviously that was the way to go. You know, if we were in a bull trend, by all means, I would have held that all day. But when we're counter trend trading on some bounce like this, and then look at how that daily candle ended, disgusting rejection. Now, followed by a little continuation, but I'm not going to get bullish right here off of, I mean, this is it. This is our bull case on the daily. It's like bullish divergence from these lows, left the bearish control zone and got a hard buy signal. We got above the 8. Yeah, I'm good. If we can close above the 21, I'll start paying attention again for like a move back up, like from 20,000 back to like 22,000. But I don't know. It just doesn't, it's hard for Bitcoin to make a compelling case right now when it's literally just hanging out at the lows, just putting in lower highs and just overall sucking. So hopefully I made my point. Ethereum. So Ethereum's still well off of the lows, holding up much better. We see it was unable to get back above the 8 right here. So Bitcoin is up here retesting the 21 basically, you know, and Ethereum is still below the 8. Hard buy coming out of the bearish control zone, bunch of green histograms. You know, arguably, you could say, we talked about this, we retraced back to the 618 level, and it's holding for now, which was also the potential top of this one right here. So, you know, depending on how we're looking at this as a macro one or as one of the 5 right here, staying above that level for me is key support. So if we stay above that level and start to move up right here, I think there's a legitimate possibility we could actually see, I thought I had one more in the middle here, maybe not. You know, there's a legitimate possibility we could actually see Ethereum rally up here. Now, Ethereum already had its big news. You know, it had its big fundamentals. So what's going to propel Ethereum suddenly to like put in new cycle highs? I mean, everything else has to also. Bitcoin has to. Does Bitcoin seem like it wants to right now? Probably not. So I wouldn't get too excited about this. It's probably going much, much lower. It's probably going to my base case scenario, which is like 500 to 600. You're like, I hate you. Sorry. The truth hurts. Call me the bearer of bad news. So still above the 200 simple for now on the weekly. Stoch's turning down. Momentum turning down. Slope line red. It doesn't look good. Doesn't look good. I mean, it's hanging on for dear life right now. But this is what I mean about the trap door. When you're just sitting on support like this, you got to be careful that it just doesn't fall out of bed all of a sudden. Because it's probably a bunch of distribution taking place. And they're holding the price up until they, capitalize on the liquidity. So the monthly ETH chart, still powerful stochastics to the downside. All red histograms, red slope line, 821 bear cross. It is still off of the lows, which is good. So if it goes down below 1,000, that looks bad. And then likely we take a step down to like 750, 6, and then 5, and then 4, and then 3, 2, 1, 0. Happy New Year. Oh, wait. I think that was Ethereum's price, not the New Year's ball. Come on. Jesus. All right, ETH Bitcoin weekly looks very toppy right here. I do expect it down to the bottom of the channel, somewhere around like 0.062 or potentially 0.055. We'll start reevaluating when we get there. Total crypto market cap on the weekly, still hanging out at the 200 simple. It is technically below it. Close below it is not good. That would be technically our first close open and then another close below it. So that is basically a confirmation. It is flat. The 8 and 21 are bear across to the downside. The 200 exponential is already red, and we're barely hanging on to the 200 simple that's flat. Stochastics are rolling over. All green histograms, though. You're like, but we have a bunch of momentum. And you're like, well, we have momentum, but price action's not moving in the direction of the momentum. It's called a bearish reset. So get ready. Bitcoin dominance on the weekly. This is the full chart at the low, still hanging out. Looks like it's about to get a bull cross coming out of the bearish control zone. Does have momentum based on the slope here. This looks like it wants to take off to the upside. Normally, this many tests of the downside, I would tell you it's probably going to break. But it looks like it wants to push back up here again. And it looks like a decent surge too. So 10% upside. So what's going to happen? If Bitcoin gains 10% market cap suddenly, either a big Bitcoin only pump or mostly pump, or a big capitulation, and people finally flee shitcoin / altcoins. And then we look at the Bitcoin dominance chart without stable coins. We see that Bitcoin is gaining dominance. It's up to 50% right now. So we see obviously people are moving away from altcoins back into Bitcoin, with the exception of the stable coins, which again is a proxy for people buying, dollars, basically. Crypto dollars is essentially what those stable coins are. All right. Making pretty good progress here. Got through the cryptos. Let me jump back over into chat. Make sure you smash up that like button, my buys. Ralph Smith says, hey, joined late, catching up. Good to see you, Ralph. Parag says, crypto trend trader, can you talk about the trigger for your Bitcoin buy and sell? Parag, hopefully I already got that for you. But just to recap, in case I wasn't clear, I was just looking at shorter time frame chart. Basically, I was looking at a 15-minute, a 1 hour, and a 4 hour, and then the daily, which is what I always watch. So the daily was irrelevant here. But essentially, what I was looking for was the bull cross on the 4 hour right here. Once we consolidated, I was looking for a back test to buy, and that's where we bought in, was off of the bull cross, expecting potential continuation. Now, could this have happened and it just pushes up and then rolls over? Yeah, it definitely could have. But when you look at the risk reward right here, when we're buying the cross as it's confirming, and I believe actually I technically bought I can't even remember which candle it was. It was like somewhere around here at 19. No, wait, I think it was up higher. Oh yeah, it was close to 19.2. It was somewhere around here. But the idea being that if we back tested the 200 exponential and simple, we were looking at a roughly 5% move to the upside. Like a $1,000 candle basically. And if we were going to break down from here and get another false alarm like this, that basically if I was buying at the cross or around the cross, I would know within 0.5% or 1% if we were breaking back down. So for me, the way I looked at it was, I have like a 0.5% soft stop loss or a 1% stop loss, and then I have 5% upside. So for me, it's 5-to-1 risk reward ratio to take the trade to the upside with my target of the 200 exponential and simple. And then to tell you the truth, I could have rode it out a little bit, but we kind of stalled out at the 200 simple right here, and I just locked in gains. I tell everybody in real time when I'm entering trades, what I'm looking at, when I'm exiting, etc. And the reason I exited was I didn't want to just give it all back. Now, I didn't know we were going to trend up a little more and then just melt down. But, money in the bank is always better than being up on a trade, not locking it in, and then it turns into a loser. And I had a feeling we were going to get one of these fucking Bart Simpsons because, crypto's just been trash lately. Now, if we look at the shorter time frames, when the 821 happened on the hourly, we see it pushed up. This was like our back test, and then it was holding. And at the same time, once we got above like that 9.2 level, that was like reclaiming the 200 exponential. So basically we had on the hourly, the 821 bull cross, reclaim the 200 simple, back testing 1, 2, 3 times at the 200 exponential. So for me, it looked like we were about to just explode to the upside. And the obvious target, is obviously the back test of the 200 exponential and simple. We have a decent amount of support through this area or resistance when we get back to it. So, there's a cluster. It's going to be very hard to get above. Obviously you see here 20,400. We couldn't get above that. But once we broke through, this level, we just shot straight up. And now here that same level is acting as resistance now that we're back trying to back test it. So again, the same thing could happen, but the risk reward's not there now. You could say, oh, I'll just take that same trade again on the 4 hour. So we crossed up, so I'm going to buy right here. But I mean, the obvious target is the 200 exponential and simple to just put in another lower high. So the risk reward is crap now. Like it was great when we took it, but now it's junk. I mean, it's like 3%, 4%, and you're like, oh, well, that's not like terrible. But I guess it's honestly not that terrible. But I mean, again, that's just assuming it gets all the way up there, and then obviously compared to a 1.5% downside, it's tough to try to take the same trade over and over again. And, I'll trade a range more, but when we're making lower highs or whatever. Also, once I lock in gains, I'm usually like not that quick to just take another trade in the same asset because I don't want to just give it back being like reckless, or I usually like to let the price action develop. So hopefully that got you there. Yeah, for sure, brother. All right, so gold. So we saw gold rally, obviously off of new cycle lows, had a powerful candle come in here, back testing the 8, closed above the 8, off of the bearish control zone. Sure, great job, gold. You fucking did it. You're amazing. You put in brand new like cycle lows, broke below key support, broke below weekly 200 exponential and simple moving average, and then you rallied a little bit off the lows. Congratulations. This literally excites me zero. All red histograms. This chart's getting worse and worse by the minute. And when we look at the monthly, confirmed already the 821 monthly cross. So people are like, yeah, but we're up 5% on the day. And it's like, sure. I mean, where were the bulls at when we were trying to like save this cross? Where were the bulls at when we were trying to not put in new all-time cycle lows? So who cares where they're at now? They're like, oh, they're here now. It's like the firefighters showing up after your house burns down and like spraying water on it. You're like, wow, congratulations. You put out the embers. And you're like, yeah, no problem, man. Glad to help. You're like, I mean, my house already burned down. And you're like, yeah, but the embers. And you're like, sure. Thank you so much. I appreciate it, gold. Good job, bulls. I mean, that's how I see it. Silver, still trash. Like, dead cat bounce off of key Fibonacci level. Obviously, we expected that to hit. Also, the measure move right here. But again, just continuing to trend down. It needs to at least start putting in higher lows right here. So you can start looking at it and saying, okay, we can try to build a little bit of some kind of case for silver. But I mean, as long as it's doing something like this, pinching into this right here, and then it looks like basically a little descending pinch triangle, it looks like it's probably going lower. Now, could it break out, shoot back up to like $22? Sure. Definitely could. Silver monthly, we know what that looks like. Gold silver ratio, backtesting the 200 exponential and simple, trying now to fight for the 821. It does look like silver wants to strengthen compared to gold short term before eventually gold rallies compared to silver. GDXJ. So we talked about this key break from this descending support channel. GDXJ has been in forever. And then also our fib level as well. We broke down below them and now we're backtesting. We broke down below them and now we're back testing. So we're not going to get bullish at resistance after we just broke support. So it was support. It had all the time in the world to act as support. Nobody bought. Instead, people sold. We broke down from that level, and then people bought the sell-off for the back test. So what's going to happen now? Is this just a spring, and now we're going all the way back up, and this trade setup starts looking pretty juicy? Maybe. I mean, I don't like the looks of it. I didn't take it, obviously, before. We talked about why I wasn't going to take this, because gold and silver looked so weak. Even though the miners started looking good, I wasn't going to trade against the overall underlying asset. And silver junior was the same way. We came all the way down, literally touched tips. We just touched dirty little tips with this blue ascending support line. And you're like, oh, you just move them when nobody's looking. To which case I would say, maybe I do. No, I'm just kidding. But seriously though, I mean, look at this shit. This is our monthly chart on silver juniors. Close right here, closes right here, and then look at that little wick down here to the 618, exact target area. So, I mean, do you get juicy and jump right in this? I mean, I didn't. You could. You know, obviously this was the exact area we talked about for this trade setup, which was the potential for 78% move to the upside. And we came down exactly to, you know, that entry area. I mean, give or take a couple pennies. I did not take the trade. I'm not confident in what's going to happen here. We'll see how this monthly candle closes in the next couple days. And then potentially I'll enter into something closer to this. 66% upside, 15% downside. There's still some serious potential on the silver junior miners. But not jumping the gun right now. I really want to see how these next couple days play out. It seems like you're always kind of waiting for something. But the truth is, when you know exactly what you're looking for, trade setup wise, and you have a system like I do, like we do, it's so much better to just, I mean, everybody likes to get up to the plate and the fastball's coming and hit a home run. Everybody likes that. But you're not always going to hit a home run. We know that. But it's much better to hit a bunch of, you know, singles and then occasionally hit a home run than it is to just go up and strike out over and over and over and over, and then finally you hit a home run. And then you strike out and strike out and strike out, and then you hit a base run. And then you hit a home run. And then you hit a base run. And then you strike out and strike out and strike. I'm the opposite. I would rather just hit a bunch of singles, just little gains, locking in gains, taking the easy trades, you know, and then hit the big ones here and there, than just try to trade like every single trade setup that shows up. If something just doesn't look right about a trade setup, or it's just not quite there, or something's a little off, or I'm not quite getting the confidence I want, I'd rather just pass most of the time, or I'll take like just a tiny little position or something. But the truth is, there's enough assets, there's enough markets, there's enough places that we can bet. We can always just take the easy bet with that higher percentage of success, and then we can end up with, you know, a nice batting average instead of coming up there and striking out 9 times in a row and then hitting a grand slam. Because eventually people don't want to let you bat anymore. I mean, your confidence goes to shit and when you lose a bunch of trades in a row over and over again. All right, so GSG. So obviously we saw energy and commodities bounce. You know, again, new lows below the 200 exponential and simple. Does not look like a good chart to me. But again, there's still some potential upside back to like 21 or so. FCG. First Trust, natural gas, ETF, backtesting the 200 exponential and simple. Still looks like we're headed down to new lows. Again, this is just reaction rally in my opinion, towards the end of the monthly close. And then obviously like news driven as well. CCJ, Cameco. So I had a little rally off the 200 exponential right here. Still bearish on it overall. Nothing really changing on uranium space. You know, a lot of these rallied like 5 to 8% today. But like, you know, it's great when something rallies 8%. It's like super exciting. You know, here's a 9% rally on quadruple UPL. 9% rally, right? That's great, right? And you're like, well, what really happened though? It just got to where it was like 4 days ago. So you're like, oh, okay. We're up 9% today. Hey. You're like, but we're still way down. So I don't know. I don't really get excited about these like little moves like this. You know, we obviously take profits on something, and then it goes well back below our entry point. And then when it backtests my entry point, I'm just like, oh, let me FOMO back in. I just don't see it. I mean, there's possibility. A lot of these look like they're kind of bottoming at some key support levels or whatever, but not like macro bottoming. More like just like another dead cat bounce bottoming. So Canopy Growth, CGC, came back down to that entry level. Obviously, we took profits on this a long time ago. So again, we could have had an opportunity to just re-up the same way. You know, basically everything gave you a second chance to just rebuy the lows. Well, very often when you put in a macro low, the market doesn't give you an opportunity to just buy the lows again. So if you have a low and then like for a macro, now you can have double bottoms, you can have double tops, stuff like that. But a lot of times markets doesn't give you a second chance. It doesn't work like that. Tilray, new lows, back testing the breakdown. This is new like cycle lows, but not all-time lows. You guys know I'm still waiting for a little bit lower lows for the all-time lows on Tilray. I mean, this value pricing though is just ridiculous. $1.30 on ACB, not quite as good fundamentally, but holding on. And then the cheese chart. Oh my God, this is the worst chart I've ever seen in my life. So I talked about, and by worst I mean best or just most chaotic. This is the most ridiculous asset I've ever seen in my life. It's right here at 25 cents. I can't remember who requested this, but good God, sir. You either have little money or huge balls or a combination of those two things. A 25% candle. So it closed here, went down 25%, retested 200 exponential, and then gapped back up the entire move down. I mean, how do you even trade something like this knowing that at any point, 29% back up, at any point in time, you could literally get a 25% down candle instantly, followed by a 30% up candle. I don't even know what time frame. I mean, look at this. This is a fucking joke, right? This is a joke. This is a 1 hour chart. 25 cents to 18 cents on the hourly chart, 19 cents, whatever. And then literally in between the time when the hourly closes and the new hourly opens, it's back at 25 cents. And then it does nothing for hours and then gets a giant green pump and then closes. I mean, there's no liquidity in this. This is the worst asset I've ever seen. I mean, or the best, depending on how you look at it. But I mean, Jesus. I don't know how. Let's look at the 1 minute. This is not organic, tradable, legitimate price action. There's no way there should be 1 minute 25% candles on any asset ever. So please, for the love of God, be careful. And do not put any actual money in this. And by actual, I mean like large quantities. But anyway, I thought that was funny. I thought I was about to be made a fool with this cheese pump because I said, you know what, instead of longing it, why don't you short it? And then here we are. After the short was looking good, then it was looking bad, and now we're right back at neutral. I did not short this. I'm not betting on cheese one way or the other. I love cheese, so the last thing I'm going to do is bet against it. And I know this is not actually cheese. It's Chili's, which is, I looked it up a little bit, and Chili's with a Z like that, it means it's a combination of both chili and cheese. So, you're basically betting against, an American tradition. So, I don't know if you've ever had a hot dog before, but if you're betting against chili cheese dogs, fuck you. You're a loser. But anyway, I think that's it for our assets. So we made pretty good time there. Knocked through everything about an hour and 38 minutes. So yeah, I think that's perfect time. So we'll go ahead and cut it off there. Obviously, the big thing to look forward to is the end of week, end of month, end of quarter, end of the world. Probably not. Stream. So that will be on Friday, 11 a.m. We'll probably go a nice long stream then because I do expect a bunch of volatility tomorrow and Friday as well. We know key levels to watch for. The most important thing, just watch the hourly chart, guys. Watch the 1 minute chart, guys. It's super important. No, watch the monthly charts for whatever assets you're interested in and see where they close and say, does this monthly close make me more bullish, more bearish, or change nothing? And if it changes nothing, are we already in a bull trend or are we already in a bear trend? Because if you're already in a bear trend and the monthly close changes nothing, you should still be fucking bearish. And the same way on like the DXY or something that's in an uptrend. If the monthly closes and doesn't look amazing, but we're still clearly in a bull trend, just remember that. So I'm not saying this won't be the top on the 10-year. I'm not saying this won't be the top on the DXY. But you know what, guys? Every day for the last however many years, we've been saying it's not the top. And every day we've been right. And there's other people that have woken up every day for the last 2 years trying to call tops or trying to call bottoms. And they've been wrong every fucking day. So I like my odds. We're We're what, 2 years in a row? We're 700 times we've been right in a row, and we still haven't been wrong yet. I like my odds. I think I'll stick with the easy setups. It's not a lot of things you can do 700 times in a row every day without being wrong, or without messing it up. So that's the power of trading with the trend. We get 700 days of trend in our favor. So that being said, hopefully everybody enjoyed the stream today. I appreciate everybody tuning in. Make sure to smash up that like button. Make sure you are subscribed before you go. And then we'll see you on Friday for the 11 a.m. Eastern Standard Time. Friday wrap-up, monthly wrap-up, the quarterly wrap-up. And then we're going to start talking about, obviously we'll talk about the month, sum it up, talk about the important levels. But the most important thing is, once again, we'll be looking for that next quarter, that next big asset, the next big move, the next mover, potentially for an end of year Santa Claus rally. So make sure you tune in for that. Obviously, make sure to take profits along the way, protect yourself. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. See you every single Sunday and Wednesday from 8 p.m. till roughly 10 p.m. and then every Wednesday, 11 a.m. till roughly 1 or 2. But that's it for today. Crypto Trend Trader on 9:44 p.m. Wednesday, 9/28/2022, and I am getting the hell out of here. Everybody have a good night. Appreciate y'all tuning in. I see all those laughs in the chat. Everybody have a great night. All right, I'll catch you guys later. Peace.